Hello, and welcome to our Macroeconomics podcast update. My name is Andrew Brown, and today we will be covering the topics of unemployment, GDP, inflation, and current account balance. The first question we have to answer is, what is the current unemployment rate in the economy? What circumstances led to this rate, and is it historically high or low? Well, according to the U.S. Bureau of Labor Statistics, it states that as of November 2024, the U.S. unemployment rate stands at 4.2%, with approximately 7.1 million individuals unemployed. This marks an increase from 3.7% in November 2023, indicating a slight increase over the past year. Some factors that can contribute to this are hikes in Federal Reserve interest rates in an attempt to curb inflation, manufacturing and other industries having to lay people off, and economic deceleration leading to reduced hiring. Our second question is, what is the current rate of economic growth, or GDP? Is the economy experiencing an expansion, recession, or recovery? And is this a healthy rate of growth? In quarter 3 of 2024, our GDP grew at an annual rate of 3.1%, following a 3% increase in the second quarter, according to the Bureau of Economic Analysis. This growth is majorly attributed to increases in consumer spending, exports, business investment, and government spending. Projections for the fourth quarter indicate a deceleration, with growth estimates ranging from 1% to 2%. This pretty much means that while the economy is expanding, the pace is slowing, indicating a transition from rapid recovery to a more sustainable growth rate. A 2% growth rate isn't necessarily bad, as it's considered healthy, as it aligns with the economy's long-term potential without fueling inflation by helping prevent overheating and maintain economic stability. Our third question is, what is the current rate of inflation in the economy? Is it too low, too high, or just right? What, if anything, should the Fed central bank do about this inflation? Explain. Well, the Consumer Price Index, or CPI, rose by 2.7% over the past 12 months, ending in November 2024, slightly up from a 2.6% increase in October, according to the Bureau of Labor Statistics. This rate is a good amount above the Federal Reserve's 2% target. Given how close it is to the target, the current inflation rate is manageable. The Federal Reserve has responded by cutting interest rates by a quarter percentage point to a range of 4.25 to 4.5%, indicating a cautious approach to handling inflation. Further, rate adjustments will likely depend on future inflation trends and economic conditions. 4. What is the current account for the U.S. right now? Is it experiencing a deficit, surplus, or balanced current account? Is this good, bad, or neither? Explain why. Well, in the third quarter of 2024, the U.S. current account deficit widened to a record $310.9 billion, which was up from the $275 billion in the previous quarter, according to Haver. This deficit equates to 4.2% of GDP, which is an increase of 3.8% in the prior quarter. A current account deficit indicates that the U.S. is importing more goods, services, and capital than it exports. While this reflects strong domestic demand, persistent deficits can lead to increased foreign indebtedness. However, the U.S. has historically sustained current account deficits without immediate adverse effects, suggesting that the long-term situation is not inherently problematic, but should be observed for potential implications. In summary, the U.S. economy exhibits moderate growth with manageable inflation and a slight rise in unemployment. While the expanding current account deficit merits attention, the overall economic outlook remains stable as of December 2024. We covered a lot of material today, and the main thing we learned is that unemployment is at 4.2%, which is low but rising, reflecting a softening labor market. The GDP grew 3.1% in Q3 2024, but is slowing to a stable 1.1 to 2% pace. Inflation at 2.7% is manageable but slightly above the Fed's target, prompting cautious rate cuts. Finally, the U.S. deficit widened to $310.9 billion, signaling strong demand but raising long-term concerns. The U.S. economy remains stable with moderate growth, low inflation, and manageable risks, though rising deficits and unemployment should be given attention. Thank you for listening.